Matt Luciano again, and last day of trading in September. A lot of volatility in the markets, and I want to speak to you a little bit about global macro today. There's a couple different kinds of global macro funds, one being systematic, the other being discretionary. Two very big differences are discretion, the manager is able to use his research and make decisions on the fly versus his, to reflect his projection, what's going to happen. They do studies, they come up with themes. A lot of discretionary macro funds operate on, whether it be 3 or 8 major themes. I mean, that's what Drawbridge has done traditionally, and they've done well. I haven't seen them, their numbers recently, but that's typically how they made a lot of money, big bets. So the bet could be short emerging markets, long developed markets. It could be short oil, could be long oil. Just these big bets, heavily weighted positions. Sometimes they're hedged to a minimal, sometimes they're unhedged, so very directional. A hedged trade could have a myriad of legs to it, with derivatives, stop losses, all sorts of buying signals and selling signals above levels. So that's what the team would do. Systematic would be based on systems, quantitative systems, price action. They could be candlesticks, could be volume, buyers, insider transactions, could be crossing moving averages. That's a curious way to do it. If a stock is going up and it crosses a 50-day moving average, that could be when they buy it, or 200-day moving average. It's really whatever the manager believes to be an accurate prediction of what works and what doesn't work. I've always been more of a believer in the discretionary managers than the systematic. When I was at Bank of America, managing about 400 million, I promptly let go of all the systematic managers as soon as I can. I did my best, actually timed them pretty well, because they're pretty easy to time. They go up, they go down, they go up, they go down. So you just actually kind of wait it out to when they go up, and then you get out. If the fund was up 10% through the 25th of the month, I'd pull the trigger and get out of it. Usually they had 5-day notices to get out, or I'd put it in advance to get out. And then I doubled down on some of the directional managers, and that worked out really well for the fund. It made them about 20 million in a few years. Recently, macro funds have been flat in the last, I'd say, 4 years. There's been actually some that outperform, but as an aggregate, when you look at some of the aggregated indexes, HFR, namely, or Barclays, kind of been flat for the last 5 years. But if you dial it back from 2000, 2003, those 4 years, a lot of managers averaged out nearly 20%. So we could be setting up for a time to get back into them. And now they're tough to time to get in, so I just recommend doing it. Probably lightening up on your equity exposures quite a bit, because they're getting really too choppy, and there's just really so much volatility. I'm losing money in a couple stocks with 9% dividends and wickedly strong balance sheets. So it really makes no sense. So that's kind of where I'm at with macro, systematic, discretionary. There has been a lot of money into it. Pensions are okay with it now. They took them a long time to get used to it. They used to track funds for 3, 4, 5, 7 years before they invested. Pretty tough to work with if you're a marketer of funds, when they keep saying, I want to watch it a little longer. At some point, you really have to pull a trigger, or you're not interested. You're just wasting people's times. But that's kind of it for today, and I just want to thank you for spending a little bit of time with me. And if you have any questions, obviously you can post them to the bottom of the site, and I'll answer them. Thank you.